There is a company that pays reliable, stable monthly dividends, 12 cents per share or $1.46 every year. And the stock price is $33 as of the time I'm making this video. The dividends were growing all the time and they are expected to keep growing. The company's business is relatively easily scalable. Payout ratio is very high, and just like other real estate investment trusts, they spend almost all their income on dividends to be qualified as real estate investment trust and don't pay any corporate taxes. Previously, I already made graphs that show how reinvesting dividends every month is more effective than reinvesting dividends every year. It is more effective, but the difference isn't that big. The company is named STAG Industrial. It is a real estate investment trust focused on the acquisition and operation of industrial properties. And the company owns 559 buildings totaling 111.5 million square feet or 10.36 million square meters in 40 states. The list of tenants is very diverse. The largest one is Amazon, 3.8%. This means that the company is not highly dependent on one single tenant, and this is very good. According to conventional valuation ratios, the company seems pretty expensive, but since it's equity-only real estate investment trust, it's better to use a price to funds from operations ratio. This metric is calculated by adding amortization and depreciation to the net income and then deducting the gains on the sale of properties. And STAG Industrial price to funds from operations 15.39 as of the time I'm making this video. This is about average value, so the company is not expensive, but it's not cheap either. Low return on equity is common for this sector. STAG Industrial's annualized return on equity for the first quarter that ended in June 2022 was 3.81%. This is also about average value for this sector. The company is focused on industrial buildings like warehouses, distribution centers, and other commerce supporting infrastructure. E-commerce sales will drive demand for industrial real estate. It's more profitable for companies to rent warehouses and sell goods online than to operate shopping centers. In 2040, 95% of all purchases will be made online. Sales are not the only reason e-commerce companies typically need more space. Product returns fill shelves too. Customers are 3 times more likely to return products they bought online versus those they bought at a retail store. So e-commerce companies need 20% more space to manage reserve logistics compared to normal sales. So the industrial real estate market that is currently worth $1 trillion and highly fragmented is expected to keep growing in the future, but not as fast as it was before. Over the last years, the company has shown a stable growth of revenue, net income, dividends, assets, and it will continue to grow, but the growth will slow down. STAG's revenue is forecast to grow at a rate of 8.5% per year. It's noticeably lower than it used to be. During the pandemic, e-commerce had shown explosive growth, and accordingly, the demand for industrial real estate increased too. And apparently, right now we have high base effect. The demand is slowing down. One of the company's risks is that it owns primarily single-tenant properties, and they are riskier compared to multi-tenant properties. Another risk is that the company still owns many properties that are less desirable than the prime location properties. It is important because it is only profitable for companies to rent warehouses when they can fill them to the maximum. Searching for new tenants is difficult and property needs spending in the meantime. So during recession, slowing demand for industrial properties, the company's business will probably be suffering, especially because of its riskier property types. Given the current situation in the economy, the company's earnings are forecast to decline by an average of 0.7% per year for the next 3 years. But in the long term, it is worth waiting for a slow, stable growth. The company has long-term debts that grow along with the company's assets, but the company's interest coverage ratio is relatively high, 4.4. Therefore, it shouldn't have problems with debt servicing. So the balance sheet looks fine. To sum up everything, the company will keep being a stable, reliable monthly dividend payer for a long time. And there are risks, of course, but they are low comparing to other companies. So don't expect big profits here since it's relatively low risk. That's all. Thank you for listening.